futures and commodities the same? When most people hear a discussion about investments, they may wonder if there is a foreign language involved. Words seem familiar, but their meaning is so hard to catch. But even if you have already mastered some stock market vocabulary, there still are terms that might confuse you. Why and how can you dilute shares or stocks? By the way, what's the difference between stocks and shares? Which squeeze is better, a long or a short one? How do you tell futures from commodities? Don't worry, we'll help you, at least with the last two. What are commodities? Oh, you know them quite well, as you are bumping into commodities literally all the time. Open your fridge, see some milk and eggs. Or think about coffee or sugar in the cupboard. These are commodities. Do you have a car or a bike? You need a commodity to make them move. Your golden ring or stainless steel cutlery, made from commodities too. Basically, commodities are tangible, physical goods. They are raw, sometimes even living, and can be traded in bulk. But what's more important, they are fungible. This means that who and where makes those goods doesn't really matter to the buyer. Wheat from North America has the same characteristics as European, the same with oil, beef, copper, and a lot of other products. Commodities are the oldest form of investing and have played a great role in human history, just call to mind the Silk Way or Gold Rush. Nevertheless, nowadays they are considered an alternative investment. How do you trade commodities? The most obvious way is to simply buy those goods and keep them or sell them later for a bigger price. But just think about logistics. If having a few gold bars at home seems to be an appealing picture, what about a herd of cattle in a backyard? That's why commodities are sold and bought on public exchanges, just like stocks. There are exchanges that specialize in a specific type of commodities, such as the London Metal Exchange. Still, most of them trade a range of different goods. At the beginning, commodity exchanges were a place where a manufacturer meets a buyer. These days they host a number of investors who want to get a profit from a commodity price change without actually buying goods. How do they do that? Commodities are mostly traded as futures or options. Those contracts help with the logistics and allow both buyer and seller to fix prices and do some planning ahead. As they can be bought and sold before the expiration date, investors use them for speculation. Another way of investing in commodities is through stocks of companies that produce or process those goods. However, it's a bit of a different story, as prices of such companies are not strongly connected to the prices of commodities. Or you can choose commodity-oriented exchange-traded funds and mutual funds. Okay, now what's about futures? Futures are derivative contracts which are designed to lock a specific price of a certain asset. The buyer of a future is obliged to buy and the seller is obliged to sell this asset for a predetermined price at a future date. Those contracts are standardized and traded on the exchanges. Historically, first futures were concluded about commodities, rice, corn, wheat, cotton, gold. No wonder, those were the things that mattered to our ancestors. But nowadays future contracts can be about a lot of different things: commodities, stock indices, individual stocks, currencies, bonds, exchange-traded funds, even Bitcoin, you name it. How do you trade futures? In the first place, futures are used for hedging purposes. A bit of certainty about prices in the future is good for businesses. You need a commodity, you like the price, you fix it with a future contract and you get what you need at the expiration date. However, there is another way of getting profit from futures. For those who don't want to actually buy assets, futures are securities on their own. How so? Imagine you bought some oil futures with a predetermined price of $70 per barrel. If the oil price goes up to $80, you can find a good number of people willing to buy your futures for a higher price than you've paid. That's why futures are considered as a way of speculation on asset price, as long as the trade is closed before the expiration date. An important thing about futures, though, is that they are based on leverage. When purchasing a future, you don't pay the whole price of the underlying asset, just a tiny bit of it. But as the contract implies an obligation, you'll have to actually buy this asset or to sell the contract. In case the price of the asset goes down, you might have to sell the contract for a much lower price than you've paid. So you need to be careful. Losses in futures trading can be as big as the gains. To sum up, futures and commodities do have a strong connection. Commodities are mostly traded in the form of futures, and a good deal of futures underlying assets are in fact commodities. Both of them have value, both can be traded on exchanges. However, they are not the same thing. Commodities are tangible, material goods that can be bought or sold in the real world without a middleman. Futures are contracts about assets, including commodities, but they exist only on exchanges and have no value without those assets. To make it more clear, think of commodities and futures as two sets that are partially intersected. In this intersection, you'll find commodity futures, but the sets themselves are two different concepts. That's all for today's video. I hope you find it interesting and helpful. Let me know what you think about commodity trading in the comments below. Thanks for watching, and don't forget to subscribe so you don't miss any of our new videos.